rehearsal. Let's go live.
All right, we got to have that conversation again.
Do I have a time to change to flannel shirt as well? Or
Good morning, guys. We
Excuse
just
me.
had the funniest, most useless conversation about flannel shirts, and I was just saying I was making sure that the video was live, and then I looked over like, nope, not live. So I haven't done this in a couple years. Welcome to the Wednesday webinar. Um, yeah, so Bennett's gone. He's on vacation. Founder of the business is trying to figure out how to do this live stream again, but I think we've got it. Good morning. Thanks for hanging in there, guys and girls. Welcome. The boys were making fun of my flannel shirt, and I guess but hey, upstate New York, Terry, and then Terry's got his flannel, and Alex asked if he has time to go
Hey,
put
it's
his
cold
flannel
down
shirt on.
here.
Yeah,
Yeah,
we had we had our first snowfall last night. That was fun. So, anyways, guys, just type in the chat. Let me know, is audio okay? You guys can hear okay? Again, Bennett usually runs this. I'm just getting back up to speed here, and I think we're good to go. So just type in yes if you're watching, and we'll jump in here. Yeah, hey, good morning, Alex, Lee, George, William. Not getting buried. We had about 2 inches of snow last night. So yeah, we're good. So thanks. So again, good morning. We were kind of cutting it up earlier, and we weren't even live. We were still backstage. So all right. Let's jump in. Good morning, guys. We have a lot of things going on. Obviously, a lot of rotation, a lot of questions. If the low that we're looking at is a tradable low, if it's a long-term low, there's been an unbelievable move up starting from CPI, which was sporting a 7 handle. PPI just followed it up. Month over month was 0. As the Fed is talking about easing off and the pace of interest rate hikes, and it's been so far it's received fairly well. We're right in the middle of retail earnings season. We just got Target, which missed. I haven't had a chance to get inside while the guys are working. I'm going to look inside of that Target report. But we had earnings out of Home Depot, which is good. I think they pulled back guidance just a little bit going forward, but they beat expectations. Walmart was solid. We're seeing a pretty good response here to earnings season, and we're about 95% done. And I did, in the YouTube video last night, I put it out late last night, so I don't know if you had a chance to see it, but the FactSet, John Butters of FactSet does really good work. He put up some really interesting statistics summarizing it. Even though the amount of which companies are beating earnings right now is less than the 5 and 10-year average, the upside response in the stock market to those beats is like 2.5 times what we normally expect. When a company beats earnings expectations, I think he said over the last 5 years, on average, you get a 0.9% move up the 2 days before and after earnings. Right now, we're getting like 2.5% move. So good earnings reports are really being rewarded here. And I think that's interesting and telling. And again, I think it's important that we understand the fundamentals, we understand the macro, because that helps us give clarity to the chart, the schools of chart analysis that we all love so much. So we'll get into the LIQUIDITY count. We'll look at what's going on. Terry, when we were talking to ourselves and we were thinking we're alive, brought up a good point. Terry, what did you say? We're not going to go back to normal.
I said we're in a transition phase. If we are going to move back into the bull market, we're not going to immediately go right back into what we had when we exited, right? So growth is still mostly out of favor, but there is a transition. There's a signal going on that's showing us that things are changing. So the bull market starts off and it goes through several stages, and the first stage is not going to look anything like the ending stage. So that's what we're poking through right now.
Yeah, agreed. And I was gonna call an audible here and kind of go on what Terry was saying right there. This is a chart that I really like, that I think it puts it all in context as to what's happening. And I'm going to show you this long-term 100-plus year chart of the Dow, and then roll into what we think, the way we see the indexes in terms of the LIQUIDITY count. And I love this. Let me just confirm, guys. You could still hear me, right, Alex and Terry, as we're on the screen?
Yeah.
Okay, perfect. Terry?
Yeah, I can hear you. I'm just self-muting, just trying to. There's a little bit of background noise going on.
Yeah, I think that's on Alex's side. Let me just see if I can Alex call. That might take it out. Yeah, I think it's on Alex's side. Alex, you might need headphones if you have them. It's no big deal. Okay, so this is a chart that I really like, and Alan is I see Alan in here. Alan's a lifelong technician. Actually, that's a different Alan. Sorry. But I really like this APTR on Thinkorswim. This is the average percent true range. And what you do is you take ATR, which is, your high to low range over a given amount of period, and you look at, what that range is, realized volatility over a certain amount of time. And this is the Dow Jones Industrial Average going back to, this is awesome that Thinkorswim has this. It's like, I think it's going back to like 1904. So that's like 98 years of Dow Jones price action. Pretty amazing. And can't you see the crash coming, guys? Isn't it just obvious that the uptrend's over? Like, you know what? Let's end the live stream. Let's just pack it up, guys. Let's go move to the islands and I don't know, open a beach bar. It's over. I'm sorry. I don't mean to be so flippant like that, but
facetious.
Facetious.
Sarcastic.
Facetious, flippant. Yeah. So I don't know, but I could clearly see the crash coming.
It's of your perspective, right? So it's.
I mean, look, from the macro point of view, the fact that we have 40-plus year high inflation, rates have broken multi-decade trends. I get it. It's scary, but the point I want to make here is, if you look at this, and if I bump this up, I believe if we go 21 here, and, you can see the average range. This is let's go to a monthly chart. All right, and let me just go, sorry, time frame setup. I want to go monthly. Oh, sorry. This is kind of an audible, so I'm not as prepared as I should be on this. This will take me 1 sec to set up. Okay, this is what I want to show you. This is a quarterly APTR of the Dow, and I love this chart. This is the average range on a 21 quarter rolling basis percent. So you're normalizing. You can compare a Dow that's 103 to a Dow that's 33,000, right? So what's happened back here in 2016, 2017? Look how low that APTR was. You had a 10% quarter over quarter for the last 21 quarters realized range in the Dow. And if you look back at that, you're not seeing such low volatility until you get back to like 1966. There was a period from the 50s into the 60s where you had extremely low realized volatility. It was a straight up market. And then what happened is we went into the 70s, which saw no price action, no price gain, but volatility mean reverted. It came off of that 9-10% quarter over quarter, let's call it 20 quarter realized volatility, came off the lows. We went into a new higher volatility regime in the 70s, 80s before we finally, the birth of the bull market was 1982 as IBM started going, and we started to move higher. So after low vol, we went into an elevated volatility regime, and then we went into the bull market and we came off. Point here is, guys, we're coming off of the lowest volatility that we've seen, pretty much in 70 years. So we're seeing a reversion to the mean in realized volatility. And you wouldn't say volatility in terms of a realized vol basis is overbought until you get to 14, 15% quarter over quarter Dow Jones Industrial Average realization. So the point is, this volatility that we're seeing, this reversion to the mean, is real, and it needed to happen. I'm not one of these guys. Look what we did and said. I did many presentations, keynote speeches at the Traders Expo Money, saying, guys, this is going to be the low in volatility. We're going into an actively managed kind of market that's going to require active management. And I actually have a screenshot of like the CIO of Vanguard who's saying, active management is done. Go to passive index funds. Low cost is the only way to go. And that marked the absolute low where we went into sort of this crazy tailspin of, not tailspin, but just crazy mean reversion. Volatility is up. So that's the market we're in. Terry said something that's really interesting. And I think that we really need to put that in historical context before we jump into the wave count as to what we're seeing. So that volatility reversion started back here in, pretty much right here in 18. And that screenshot I said when the Vanguard CIO was like, oh, go to passive, low cost. That's the only way to do it. And that's where we went down, up, down, up, down. So we had a good 4 years of hair-raising volatility back up. We've come back very nicely here, from an amazing COVID low. And then what's happening here is the nature of this correction that I still think is a correction. We covered it in depth last night in the video, and we have for members. But look at the price action that we've seen here. Look at, and let me get my new tool. I don't know if you guys have seen this. This is my new kind of fun thing. I'm gonna get on with the point here. But if you look at the depth of the correction here. If you look at the first sort of down, up, oh, that's pretty bad. I've got to reset that, never mind. If you look at this first sort of down, up, down, and then that's going to be what we consider to be the first zigzag, which is W. Then you have an X-wave connector. Look at the next zigzag, down, up, down. Look at the depth of that correction compared to this one. It's larger. And then if this is, as I made the joke last night in the YouTube video, if this is the triple Lindy, Rodney Dangerfield triple correction, the implications are for that. And again, this correction was smaller than this one. This correction is smaller than this one. You're seeing a volatility expansion correction. The depth of these three potential Elliott wave corrections are getting deeper. And that's the kind of market we're in. So is this a B wave that's going to yield new lows into C of what I think is Z, and this is like the PhD level of Elliott wave of 2? Is it possible? Yes. As we get off the daily down into the intraday, here is where we'll start having some decision times in terms of assigning expected starting and stopping points for the Elliott wave, the B wave count here. So we have two clusters of fib resistance, 4030 to 4050, and then a more significant one here, 4124 to 4155. Those are two key zones of fib resistance, on top of which is the 2022 downtrend line for the S&P. So you have 2 touch points. Here's the first test of that newly established trend line, and then we're going to intersect that higher fib resistance zone into 4125, 4155. So these are two potential stopping points for this B wave that would yield the new downtrend. I don't think this is going to happen. I think the red count, this is the blue, which is the bearish. I think for me, this is what we're going to focus on, which it's not the Rodney Dangerfield of corrections, which is the triple Lindy, which if you haven't seen the movie Back to School, Alex, Terry, I'm sure, Terry, you've seen the Rodney Dangerfield.
Oh, yeah, several times.
That's great.
Sally Kellerman was my favorite when she was teaching him poetry, though.
Oh, yeah, she is. That was funny. And then you get the Sam Kennison cameo in there. Alex, do you have any idea what we're talking about? Did you ever get any Rodney Dangerfield in Serbia?
Yeah, I mean, I looked at it before. That's hilarious completely.
Oh, he's out of his mind.
Yeah.
Out of his mind.
He gets no respect. Hey, I tell you, I get no respect. I feel like Rodney Dangerfield around here sometimes too.
What are you talking about, Professor Long? So that was kind of the thing. I was trying to make a joke on YouTube video last night. Like everyone's saying, oh, it's the correction that gets no respect. No, it's the triple Lindy, the jump he did off that and back to school movie. So I don't think it is the triple Lindy. I think it might be just as simple as A, B, and C. So we have just a zigzag, which is going to be 5-3-5. The question on the table is, and this is interesting, this is a 5-wave move. The question on the table is this the proper degree? This degree I have labeled as minor. This degree here is clearly minor. The depth of this correction, okay, is going to be, if we do a little fib study, it's a little bit more than 61%, but it didn't quite get to 100, so that's fine. The 1272 really nailed it. So you take the 1272 extension of B down to C. I mean, that's amazing right there. The risk is right here that this 5-wave move is not the proper degree. The risk is it's in fact one lower, which is minute, and it's the same degree as this little one. And this could be green 1, this could be green 2. The good news is we're going to know pretty soon if that's the case, because we're right into the 618 at 39.85, the 786 at 41.31. You're going to know right there if this is going to be a wave 2 and we're going into either the triple Lindy or something much more significant. You're going to know right away. Just looking at some fib relationships real quick, and I'll kind of move on here quickly. I know we're taking more time than we wanted. I want to get over to the guys. If you just do a fib relationship of the first move, if in fact this is green 1 and I'm wrong and this is green 1 as I'm talking about, you're going to see a pretty decent little Fibonacci relationship here. And I know in the NASDAQ, if you do this same study, it's the same percent distance change right there. Okay, the S&P is not quite there, but if you do the percent distance of this move in the NASDAQ to here, it's the exact same. That is going to maybe consider that this is 1, 2, and we have 3 to go. So we'll find out what that's going to be. I don't think that's going to be the case. I think this market is responding well. The way I'm looking at this is down here under the smaller time frame. We have a 5-wave move off of the November 9th lows. It's been sideways. I think it's a flat. It's very it's not given up in terms of anything on the downside, which is indicative of a lot of underlying strength, which if this is an expanded flat and the market wants to get a bid and we're down 1/3 to 0.5% here in Globex, if we can come in and find some support, we have a very, very strong move coming on the upside here, and we are kind of ready to go. And I want to get into Terry and Alex's world to figure out, some confirming indicators, some stocks and sectors that we want to look at on the long side. But I have a feeling this market is going to catch some people on the wrong side. I'm going to finish up and say, you look at some of these rates, the 10-year at 3.73. We have shed the 4 handle on the 10-year. We've come off very strong on yields. Look at that move down to the yields. Here's the 30. We're at 3.93. Big old move down there. The 2-year is still sporting a 4 handle because federal funds is going up to 4.25, 4.5. We'll see where the Fed finally stops. But the longer term treasuries are showing support, which is good because longer term treasuries are being sold because of long-term inflation expectations, which are coming off. So it's not risk aversion, in my opinion, that's putting a bid in these long-term bonds. It's the fear that inflation is moderating. It's okay to hold longer-term bonds, and people are coming in to grab that yield, which is still up around 4%. So key that we're looking at here again from yields is you want to watch the dollar to continue to go down. That's going to be a good thing. I want to see what Alex says on that, but the dollar does have some pretty impressive downside action. That ties into rates. That ties into inflation expectations. That ties into what the Fed's going to do, and that gives us clarity as to which is the likely path forward for the index based on our beloved Elliott wave count. Guys, what do you think?
Yep, very good. I mean, we're still inverted, right?
We are inverted.
And we're going to stay that way for a while.
We are inverted.
That's not going to be the end of the world.
No, and I do have it. I can pull it up quick while you're going. I'll throw it up here. But we do have so the 2 years of 4.3. Yeah, I mean the two and Fed funds is we're at 4 now. So we still do have yield curve inversion. So yeah, I mean, are we going to a recession? Yeah, we could come out and print a recession here, a next GDP, and the board is going to say we're officially in recession. But the stock market has already discounted that, and the stock market probably rallies anyway, even though if we do confirm with inverted yield curve. So the way we're seeing, and we've done a lot of work behind the scenes. Terry and I and Ben have been working on big FANG stocks. As soon as everyone's saying we have the defangment of Facebook, Apple, Netflix, Google, Microsoft, Meta, we're starting to see some signs that big cap tech is actually starting to show support as soon as people are saying everything's been defanged. And that's going to kind of tie in as well. Google's one that's really interesting we've been focusing on. So I'm becoming encouraged. Terry, I'm going to send it to you. Where do you want to go with this?
All right. I'm all ready. Just
You're all
throw it my
ready.
way here.
All right.
Yep.
Here you go, sir. No fancy intro that Bennett has. So I'm just
I do my intro at the beginning of once you send it over to me.
Sing a little jingle for us.
All right. Hello, traders and investors. I'm Terry Long at tradinganalysis.com with your weekly sector focus. And wow, I mean, what a turnaround week it was last week, right? Last Thursday's CPI report lit the markets on fire, and they delivered on all cylinders, with the S&P rising 5.9% and the NTX rose 8.84% for the week. When you look at it, when you get your eyes out of that microscope and you zoom back a little bit and you look at the magnitude of these moves, it's definitely significant, right? Thursday's gap higher and those large gains have pushed the S&P back above this blue line, which is the 50-day simple moving average. And the S&P is now closing in on the 200-day moving average. It sits at this 4075 level currently. The NDX also moved back above its 50-day, and it's still trailing its 200. It's around 12703. Now, all 11 sectors last week ended with gains, though it was energy and healthcare that really struggled to maintain the composure last week. They were noticeably absent on the big rise, and maybe that's because they've already had their own fairly large move up. The technology sector dramatically outperformed the benchmark index with 10% weekly gains, and the communications and real estate sectors both rallied more than 7% each. Now, also outperforming the S&P was the materials and the consumer discretionary sectors. And financials and industrials gained more than 4% each. Normally that's a great thing, but technically they underperformed the benchmark because the benchmark rose nearly 6%, right? So, that's an interesting thing. Let's fast forward to what's happening this week. And you can see markets are much more muted. First 2 days of trading, markets essentially flat, taking the time, I think, to absorb last week's move, and potentially we're already consolidating against that large rally. Now, the NDX is only slightly ahead of the S&P. S&P 0.03 to the negative, that's zero, that's flat, that's nothing. NDX held on to about a 0.5% gain over those first 2 days, but I did notice that there was a lot of give back right at the close yesterday. All other sectors are basically neutral to slightly lower. It's the healthcare, real estate, and consumer discretionary sectors. Materials also down about 1.5%, and this includes some pre-market moves here as well. Let's go over to our sector leader scoreboard. The energy sector remains high up here in the leading quadrant. That upside momentum is basically started to fade and neutralize, but we're still holding on to very high relative strength position. The healthcare sector, again, It didn't really participate last week, but it is continuing to advance into the leading quadrant. But you can see that hook, you can see that turn right there. Its absence of leadership last week shows a loss of momentum and a signal turn here in healthcare. The financial sector also continues to advance into the leading quadrant in easterly trek with just a slight amount of momentum fade. Look here at the industrial sector, though. The industrial sector continues to just chug along and migrate further into the leading quadrant. It gained both relative strength and momentum simultaneously, thus it's got this northeasterly heading that we like here. Now the staples sector kind of looks like it stalled out just before re-entering this leading quadrant. It actually does have a weakening yellow weekly price trend, but it has popped right back up into the lead. So very hesitant with what's happening there in staples. Meanwhile, mostly because of the two mega market cap behemoths, Amazon and Tesla, and not the general sector itself, the consumer discretionary sector has pushed down into the lagging quadrant now. Utilities continues fading. It's already advancing further into the lagging quadrant. Now down here in the lagging quadrant, we've had technology and real estate. And you notice this turn here. This signal here shows a momentum returning back into technology. Now, like I mentioned earlier, first phase of the market is not going to necessarily be immediately led by growth stocks. The leadership remains up here in these other sectors for now. But we do have the sign on the horizon showing us that there has been a transition in effect here. You can see rising momentum. Would love to get this to rotate all the way back to the east, but for now we do have some rising momentum and a stall of any further decline in relative strength for the tech sector. The real estate sector really got beaten down. It is the worst performing sector out of all 11, but you can also see that its rapid decline in momentum is also faded, though it's still struggling. And to really, like what Todd was mentioning, Google, we got to focus on Google because it's the market cap leader in the communications sector. It's really what's keeping, I think, the XLC down here in this lagging quadrant. And the XLC actually had been up here in the improving quadrant. It's now faded. So Todd, you've got your MotiveWave on my screen here.
Oh, I'm sorry. My bad.
I don't know.
My bad.
I don't know how much I missed because I wasn't looking at your screen.
No.
So.
It was just in the last 10 seconds.
Okay, yeah. So communication sector it had been up here in the improving quadrant, but it just couldn't hang on. Here, let me animate this for you. I'll just go back if I can grab that mouse. There we go. We'll just animate that back, right? So we had communication sector there. It attempted to rotate up into the improving quadrant, and then it made a rapid reversal. Just not quite ready to go there yet. Okay, so now the last sector that I want to talk about is this materials sector, which has been maintaining a rising blue improving trend vector. It did last week when I wrote my notes here on Sunday. I was looking at the length of this line segment right here. This line segment is just the 2 days market just opened. This is just the Monday and Tuesday's worth of effort. But last week we actually had an acceleration to the northeast, a big push in the materials sector. So I think we need to be looking, Todd, we need to go look inside the materials sector for some opportunities, certainly such as Freeport-McMoRan, DuPont. Yeah. I think there's several that are pushing this sector higher. Overall, the sector is still a mess, but there may be some opportunities. We have the signals telling us what we need to be focused on.
Yeah.
All right.
Yeah.
So I'll turn it back over to you now, Todd.
All right. Yeah. I wonder. Energy is starting to lose some momentum. The earnings have been solid, but we're losing a little bit of energy momentum. I'm still overweight energy, and I'm looking for signs to back that off. And what Terry was saying in technology is interesting, and specifically within semis, we're seeing some real strength in there. I do want to address that. Even though we are up against resistance, we're starting to see that that sell-off now against resistance, even in semis. I'll show you that after Alex. But it's important, I think, to get a feeling with what's going on in the macro front. I do want Alex to talk about cryptos because there is still a strong correlation between cryptos and the stock market. So, Alex, take it away, brother. You are going to be live now.
Yeah, I gave him the screen.
Let's fit all of what we are saying here in a kind of a macro outlook. So yeah, Fed rates. So we have a 14th of December, clearly because of the lower CPI, which we were looking for. And on the members webinar, we mentioned we might see even a lower print than the forecast around 7.9. We got to 7.7, and I think this will even on the next one go a bit lower. That's kind of my observation. But anyhow, the CME Fed tool, which kind of it's a market observance what the rate is going to be in the future, of course, discounted the 75 basis points move to a 50 basis points move for the next Fed meeting between the 4.25 to 450. And then on the 1st of February, which is a kind of a bigger time in future, you will see that we are pricing in almost 50% now that the rates might stay actually there without just a 25 basis point move. So obviously the Fed mentioned they will go in a smaller increments, and therefore you see the dollar lower, and of course the interest rate differential as one of the main components starts to plays in because the other central banks like ECB has to further continue to push rates higher. So our 10-year yields chart has been fruitious around this level, starting to have a really impulsive movement to the downside. I don't see this still as a complete cycle. I'm looking for a wave 4 until the end of the year, maybe in January, and then one more small push on the upside to complete this cycle from the COVID start in the 2020. So technically, I do see conditions that we go relatively in a pretty sizable move down, either in a flat or in an ABC, and then continue for a couple of weeks or maybe months or two higher. And actually, you can also see that on a 5-year. If you look the chart pattern, so we are pretty much most likely over with the wave 3, wave 4 down, and a wave 5 on the upside. So these two charts kind of fits in together. And also, if you look 10-year Bund in Germany, it is pretty much the same picture. So we go down in a wave 4 and wave 5. So they kind of aligned if you look 10-year, 5-year in US and 10-year in Germany. So you basically see the whole picture. So I think overall the macro themes are here that after February, March of 2023, we're going to start a longer period that might be follow up with potential peace talks, maybe March, April next year between Russia and Ukraine, which will be one of the major factor of dumping these inflation expectations and the real numbers much lower than we are now. There is a couple of other factors that might kick in, so we will follow that. But the charts and some of the things which are going on are actually portraying a picture that 2023-24, even some part of 25, depends which form of this correction will take, will be beneficial for assets, risky assets, to go higher. Definitely these interest rates has played a big role in a growth to value. So I think this will be a very interesting point for Todd and Terry to watch this rotation probably in February, March, where we might switch for a year or two between this growth and value, which will, I think, offer an amazing opportunity in this rotation between the growth and value stocks around February, March. So I think this will be the key point. And I think it will be good to be on top of that also for our members, as well as the longer term positioning. So let's switch and let's look the dollar index. So I'm still not actually anchoring this wave 5 here. It can be some type of a flat or a triangle. I'm a little bit more of a conservative type in a sense of calling the highs and lows. So I'm waiting a little bit more signs, especially how after a 5-wave move down, this pullback or another move higher will unfold. So I'm going to keep this for a while until we go below 101, 71 on dollar index, where was the last secondary swing lows. So I'm going to keep this one just for a touch, but definitely either way, we are in the ending cycle of the dollar on the upside, which kind of goes very well with this picture of the 5-year and 10-year in anticipation of this 2023, 24, even 25, lower dollar, lower 5-year and 10-year on the downside. So it's kind of fits a picture pretty nicely. If we move to commodities, it also fits a picture very nice. So for the risky assets and commodities to continue on the upside with the stocks and probably cryptos, these commodities, I think, this is a Thomson Reuters index, gonna spend some time here, potentially in some type of a sideways consolidation, then continue down actually until February, March. So on all of this chart, February, March plays kind of a big role for me, looking all of these charts, which is a kind of a fitting puzzle, which you need to assemble to look the macro outlook. Also oil to me, 3 waves down, some small, probably not yet over wave X, and one more push down February, March as well, kind of fits into this picture. And also net gas, this is the Henry Hub, just for the lovers. I'm still looking for a wave 4 and wave 5 on the upside. So macro picture for me is still temporarily bearish for rates, and then a final push on the upside, and then the final resolution for the next couple of years, in my opinion. So we might get 5 waves up in the S&P, and while we get 5 waves up in rates, if this is not a high, S&P can do 3 waves down and then continue on the upside. So that's quite possible. So I think we are in a terminal stages of this cycle. So if we look at gold and silver, still situation, I don't have a confirmation here. I'm still juggling between a couple of wave counts, potentially with the dollar moving on the upside with one more move. We might get one more move. So I'm waiting clarity in 5 waves up here to actually hammer this low. And it's pretty much same situation with gold. So I'm looking for another push higher while the yields will go down, gold will go up. So as you can see, all of these markets, when you put them and align them together, you will see the interrelation between them, how they move in some type of synchronicity, because basically it's the same market, just assets moving from one part of the assets class to the other one when the conditions are good for one or the other. So when you align all of this together, to me, it paints a relatively clear picture if you look the charts.
Mm-hmm. So Alex, you got an expanding ending diagonal there in gold, eh?
Yeah. That's interesting.
That's pretty wicked.
Yeah,
there's been a significant move off the bottom.
Like,
yeah, but still,
Alex,
still in 3 waves.
This is a deep conversation that's probably better served for where we have more time. But what, is it real rates that are driving gold? Gold had every opportunity to rally, and in this crazy inflationary environment, we're barely getting any kind of move up that's commensurate with level of inflation. You'd think gold would be at Peter Schiff 5,000 level. We're nowhere near it.
No.
What do you? Can you give me like a minute or two, like what's the fundamental macro driver of gold coming off the lows right now?
Yeah, I mean, I think it's a dollar rally on the downside. I was watching actually dollar moving down, gold moving up at that day. So I think it's a mix of factors. We can talk about rates and global. I mean, here actually the war started in February. Gold rallied like a very small amount, and I was very vocal on the crypto lab that we might collapse lower because it's a very a small run on the upside given the circumstances, while before, as you know, 10 years ago or 15, 20 years ago, gold will be already around 2,500 in this global event. So obviously dollar is a key to gold, in my opinion. There is a mix of rates and macro global situation. But since then, as you can see, global gold was a kind of a dead horse in this situation. So a combination with lower yields and lower dollar might produce some move on the upside in gold and silver. And that's my main thesis regarding the gold. I mean, gold is a kind of a traditional hedge, but we are moving into digital era. There is all dinosaurs also as well in a big pension funds, which are still considering gold as a primary hedge of the event. It's still a hedge within the major central banks in the world, so we cannot disregard it. So far, I know for majority of us which are looking the lower time frames, the gold is a kind of a dead asset, and I will agree with that. But I do think in this next run on the downside in dollar, gold will have its opportunity to run with the gold stocks, which we can also look through Optima and Terry and try to pinpoint what might happen with these gold miner stocks on the upside, do some wave count. So I think pretty big opportunities are in front of us, mentioning the situation with yields, a couple of years pause, and the situation with dollar. So I think we might, and possible rotation between growth and value in February, March 2023. So that's what I see.
Nice. Okay, do you want to, let's talk about crypto quick.
Yeah, crypto FTX collapse, it still has its waves. It's not done. Solana, pretty, but you know, I talked with our members yesterday. I gave the extended webinar on a Bitcoin. So what is, you will love this, Todd. So Bitcoin technically, or it's still not ready, but from sentiment point of view, we checked a very important box because the sentiment in cryptos is pretty much at the lowest point, I will say. So
That's
one box in my view is checked because you cannot go lower than this in a sentiment. Everybody is like, oh, what's going on? This will kind of decimate crypto space. Crypto is going away. You should see the kind of headlines, and we track part of that sentiment in these headlines. So crypto community is devastated. Many people lost money. Institutional players lost big money in the FTX collapse. So I don't think we can get worse sentiment than this. So from the sentiment point, I think we might have suspected that this has been a low in Bitcoin. I'm just waiting confirmation from the technical perspective.
Gotcha. Okay, good stuff. Really good stuff. And you do have a long position in Ethereum. I think we should just recently issued that to members, and I think that's a good setup. Do you want to show us that quickly here?
Yeah, sure.
And then you can go into more detail in the crypto lab tomorrow.
Yeah, I will go into more detail in crypto lab. So it's a kind of a small upside trade. I'm still kind of waiting this technical setup. So what we have here, I'm looking for some type of a C wave or a third wave on the upside. So our entry was here at current lows at 1,223. Our stop loss is at 1,100. So I'm looking for a continuation of this rally, either in a B wave, one more push on the downside, or this is actually the terminal low and we're going to continue further up. So it's a kind of a small sweet trade. which can turn into a big one, or it can turn into a smaller one up to. So it's risk reward pretty nice. Chart pattern is nice. So it's kind of aligned to put a long trade here and see what is going to happen. Of course, if we continue above this here, we're going to leave this trade to work it out further on the upside. That will be a partial confirmation that this was a low. In Ether has a much better chart than a Bitcoin. So this can be a wave one and a complex A up in B, down in C. We might be at the lows in this sentiment plays out. So it's a kind of a wait and see game now. So we put a little trade to see and test what the market thinks.
You know, I think that's a really good point. The sentiment is so terrible with the. Oh shoot! I hope I was showing your screen right there. Sorry.
Yeah, you did.
Okay, good. Yeah, the sentiment is so terrible right now in the crypto space. I think with FTX and you know, I think it's held up extremely well as the Nasdaq is sold off. Correlation still exists. Dollar strength is there, which obviously would impact crypto, but I think the relative strength is very solid in there. And I think, you know, as the market is selling off here a little bit, as we would expect from resistance, I really want to see, even if the trade doesn't work, Alex, I mean, I don't want to jinx you, and you probably should never say that as you're in a position, but even if it doesn't work and you cut it, the relative strength that Ethereum and Bitcoin could possibly show to stocks under pressure is going to be very telling, I think, for the space. If it really doesn't sell off to the degree that the Nasdaq is right now, I think once the stock market does find support, they're going to come for crypto even more. So I would say, you know, while it's showing relative strength, don't give up on it. If you have to try it a couple times, do it, you know?
Of course. I'm not giving up. I just explained to our members yesterday in this kind of a 1.5 hour long dissecting the charts in the space. I have discussed, because as you know, I'm plus 15 years on markets. I have watched many times when the sentiment go to a low point and when the people are devastated. And they asked me yesterday how actually the sentiment recovers. And the sentiment recovers by when the technical charts work its way on the upside. You can expect some good news to start to load in, and then you have a terminal point when the sentiment switch from bearish to neutral, and then from neutral to very bullish.
Got it. Yep.
So sentiment stages turnover are gradual. They are not a sudden event, but the technical patterns can tell you that a bit earlier that is beginning. So that's according to my experience watching a couple of times in different asset classes, the sentiment collapse to this level. So it's a gradual process.
Right. And then to your point, too, on correlation, this is something we were sharing with the members. Let me make sure I'm sharing the screen. Here we go. Just quantifying that correlation between crypto. This is Bitcoin futures and the Nasdaq. This is a daily chart looking back into a year ago. So you can see on a 20 period rolling percent change correlation, right now we're at 25, which is not a great correlation, but it's been up, you know, you could see it's been up around 50, 60, 70, 100%. It's a perfect correlation. So for most of 2022, we've seen, you know, I would average a 0.5, 0.6 correlation. So it's certainly there. And I think Ethereum would actually show probably a better correlation to the NASDAQ than Bitcoin does to the NASDAQ. And Alex, another point that you made, which was really good, is back to your yields conversation and the growth value debate. We've been spending a lot of time on that. And here's a chart showing growth value ratio. So iShares, I think it's IVE, so it's IVW into IVE in white. That's going to be the growth value. So growth has been underperforming value. Here's the S&P below, and you can see S&P is obviously selling off as value has taken the front seat, and overlaid in orange is the 10-year Treasury. And you can see there's very clearly inverse relationship between growth value, yields, as yields have gone up, 10-year yield has gone up, growth is underperformed value, yields sold off, growth kind of asserted itself, and then yields went on a big run here, and you can see the big rotation out of growth to value. But what's interesting is yields have really come off on the longer end quite significantly on those 5, 10s, and 30-year. They've got rid of the 4 handle, as I mentioned, and that could be the accelerant for growth, the value rotation back in, as well as the stock market coming into a low. And we'll save it for another time, but there's long-term trendline support. Terry and I have been talking about it a lot, growth value on both a log and an arithmetic scale, showing that growth value ratio is actually at support. And it's something that we really need to keep in mind. And then another one that I'll throw in front of you guys, echoing this point, here's consumer discretionary, consumer staples, going back to the credit crisis lows. Just a simple 1-2 point trend line. This is the first touch. That's the second touch. Consumer discretionary, consumer staples holding support. Might be time to reconsider our bearishness. All right, guys, closing thoughts. I think that's probably going to be a wrap, and let's just see what questions, comments, insults we have here. I'll check that, guys. Anything to wrap up?
That about covers it, but obviously we've got a lot more coming up with our member webinar. Guys, if you think you're getting a ton of material here in our live stream, you guys really need to join up. You need to subscribe to our services. You're going to get a ton more content, quality content, just like what you've got today.
That's it. Well put. Yeah, Bennett is good. I see some concerns in there. Badur. Bennett is okay. He's a much needed break. He's been working too hard. He's fried. He's taking a little vacation, as everyone needs to do, and that's going to be company policy or trading analysis here soon, guys. You all got to take some vacations, and that's you too, Alex. We had to ask you to take time off. These guys work too hard. I can't tell you how much I appreciate it. So, all right, we're going to jump in the member webinar. We're really going to get into it. See you at tradinganalysis.com. If not, you guys got to wait till next week. Sorry. All right, see you. Thanks for tuning in.
Thumbs up, guys.